Good afternoon, everyone, or good morning to those of you on the West Coast. I'm Adele Goldberg, the Executive Director here at Friends of Yad Sarah. And I just want to thank you for joining us for this Plan Giving webinar, Why Charitable Giving Matters in Your Tax Planning. We really appreciate your interest and your participation. These gifts are very meaningful for the organization and very meaningful for the donors as well, knowing that they have contributed to making the world a little better, leaving the world a little better than they found it. I know that Neal has a lot of great information ready for all of you, and hopefully some new things. And if there are areas that you feel inspired to get more information about, we're here and we're available to talk with you or to meet with you or to see what we can do to facilitate it. I just want to tell you how grateful we are for your interest and your participation. And for those of you who are in the New York metropolitan area, I hope, and who are already Jacob Circle members, are members of our Legacy Honor Society. We hope to see you at the lunch meeting on May 15th in New York City. And I look forward to seeing you virtually and in person. Thank you again, and let Neal take it away. Thank you, Neal.
Okay, Del, thank you, and welcome everybody. Happy to see you. I'm talking to you from Seattle, Washington today, and it's sunny here, which is extraordinary. So hoping that this will be a sunny seminar. It's called Why Charitable Giving Matters in Your Financial and Tax Planning. And looking at the names of those attending, I know right away that many of you have already participated in your philanthropy, and maybe this is just additive information for you. So I'm going to begin by talking about estate taxes because this is important information. I'm going to try to get my screen cleared so I can see all of you. Sorry. Okay, screen one talks about this lifetime exemption. Why is this important? For most people, it may not be, but it's important that we know what will be, not essentially what is. In 2024, as you can see, the amount of the exemption, what you can leave in your estate or by gift to heirs beyond spouse, is over 13.6 million. And if it's with a spouse, it's almost 28 million. So it's a huge amount of money for most people. And most people can simply say, I'm going to just use these exemptions in my estate to pass everything I have on to my family, and I'll pay no estate taxes. I won't give it during lifetime. I'll pay no gift taxes, and I'll let it be. But that's not what most people think. And the important thing is the second paragraph that says, as of the end of next year, all these increased lifetime exemptions you can see here will be ended, and we'll go back to another strategy, which means it'll drop to probably 6.2 million. That's half of this amount, and it'll be what we believe to be the $5 million that was supposed to be in 2025 index for inflation from 2010. Okay, why do I tell you this? Because this is the more important number. And for some people, this number has to be factored in, and we have to, of course, determine what the inflation index will be. But just assume that the unified credit, the lifetime exemption, is going to be halved and maybe lower than halved, and it won't go back to increasing at the same pace. Something to ponder when planning estates and gifts. The second thing is, I'm sorry, my screen is not. The second thing is to ask how gift taxes work. Gift taxes are what some people will take advantage of during lifetime in planning their estates and planning their finances. And in 2024, you can give away up to $18,000 a year to anyone and as many people as you want without having to report the gifts. Now, you may wonder, do you have to report gifts when you give things to other people? Yes, if it goes beyond a certain threshold, you've got to report them. You can exempt them by using your lifetime credit, but you have to report them. But any gifts you make to children, grandchildren, to anybody else in 2024, the first $18,000 for each is exempt. So again, planning. Exempt what you want to do during lifetime, and remember you have a unified credit, and for many people that is oftentimes enough. The thing about the lifetime exemption is, and not so much the unified credit more than the annual exemption for gift taxes is, it's called portable, which means if you are with a spouse, you each have the lifetime exemption, and to the extent that the first of you passes away before using the full amount of the exemption, the spouse takes on the balance along with his or her amount. So this long page, which you need not read, but you might want to look at later on when you get a copy of this presentation if you want it, will tell you that it's not automatic, that there's a way of doing it, and that there's some advantages to it. But I wanted you to know that in terms of the unified credit for spouses, whatever first spouse doesn't use up, second spouse also can make use of. Now let's talk about strategies for reducing an estate, because that would be the first order of business. And of course, as I mentioned just a page ago, we can use the annual gift tax exclusion. You could use it at $18,000 a year. 2022 is now 2024. It could be to an individual or to a trust. I show, for example, if someone has 3 grandchildren and 6 grandchildren and wants to give them each the maximum amount per year, it's a lot of money. One could give away $162,000 a year in gifts, which has 2 benefits. Number one, there's no gift tax cost in doing it. Number 2, it reduces the amount of the estate, and if you do it with a spouse, you can split the gifts with the spouse and give even a larger amount. Again, these are large numbers, but I'm just giving you these numbers in context to show how some people perceive their estate planning as they get to an age when estate planning is relevant, particularly if they have real estate or substantial interest in stocks or IRA money, 401k money, second home perhaps, life insurance policy, annuity contracts, deferred compensation. All these things add up to what is included for federal estate tax purposes. What you can give away during lifetime, if you can afford to give it away and not have it for your own, either outright or in trust, is governed by this screen, $18,000 a year per individual. You can give your spouse any amount, and it's fully excluded under what is called the marital deduction. Can go either way. So it's essentially the question about how you decide to plan your estate. Number 2, of course, donate to charity. One of the reasons we're hopefully speaking with you today is you've already done that. You've considered alternatives, and you're considering maybe giving to charity during your lifetime or already have. So some of the ways to give to charity would be, and this is an important concept, whenever you make gifts to charity, if you are making gifts out of capital, which means you're asking your broker to sell some stock, you're selling some property, whatever you use to generate cash to make charitable gifts, it's probably not the best strategy, because you want to give charity your capital gain assets. Because if you give charity stock by transfer directly to charity, you get your deduction for the full value of the stock, but you pay no tax on the gain. And that's important because some people, particularly now, have had the opportunity to realize gains on their individual investments. I'm not speaking about your IRA investments, individual investments, and might want to convert them to liquidity when the market suggests maybe it's time to take advantage of gains and move on to other investments. But the tax cost for some people is more substantial than the cost it was to buy the stock in the first place. And so the concept is, what do you do? Some people say, well, what I'm going to do is I'm going to figure a way to make gifts of stock to my charities and therefore get my deduction based upon the value of whatever stock I contribute and pay no tax on the gain. The best financial planning on a simple idea is, if you in the end of the year write your checks to charities, you give to certain charities every year and you write your checks as a giver. I'm not sure of the volume, but we'll talk about whatever the volume is appropriate to you. Might be good to say to your broker, instead of my taking money out of my cash management account or my savings accounts or even my checking account, can you find some stocks I have individually owned that have substantial gains that you think I should convert to cash and then reinvest. Let's send some of those shares to my charities instead of cash to avoid the gain. As I point out in bullet point number 3, donating in this way avoids capital gains tax because you're not selling the stock. The charity's selling the stock. You can make the gifts outright. You can designate the gifts. You can create endowments with them. You can fund a private foundation, a supporting organization, things that are connected to a charity, or donor advised fund. Essentially what I'm saying is in bullet point number 4, you can make your charitable gifts in any number of forms. The fact that you're using stock means that you're avoiding tax on that gain. I'm having a conversation this afternoon with a gentleman whose company, he owns stock in a company that's about to merge with another company. He's had the stock for a very long time. That merge is going to generate substantial profit for him, and that profit is going to be all cash. So he's talking with me now. He wants to know if he gives any of those stocks to charity or charities before the merger is formalized, will he avoid tax on the gain for those shares, which he doesn't mind giving to charity? And the answer is going to be yes, providing the timing is made, because this merger could happen any day. So sometimes these things happen quickly. It's not a great idea to wait till the time they happen, but to do it well enough in advance to give the IRS no pause to be looking at it. But an example of what we're talking to somebody about. Now, let's talk about QCDs. You see the word qualified charitable distribution? We call them QCDs because that's what the statute talks about. And QCDs are gifts that you make to charity annually from your IRA. And essentially, when I say IRA, it could be any of your qualified plan money that you roll over into an IRA before you make this strategy. With a QCD, if you're 72 or older, or if you're 70 and a half and have already started doing this at that time, and you have to take RMDs, required minimum distributions, from your IRA on an annual basis, those are taxed at full ordinary income tax levels. You know that. It's like receiving salary. It's all cash. People take their RMDs, A, because they need them, or B, because they don't really need them. They rather stay in the IRA with them, but they have to take them out or be penalized under IRS rules. So when people do that, as you see bullet point number 2, people who don't need all the annual income could donate some, if not all, of their RMD to one or more charities. And if you do it in 2024, this year, your amount now you can donate to charities in the aggregate is $105,000. Most people won't do that much, may do a small portion of it, but whatever amount you use that you send straight from your IRA to charity means that those dollars come out to satisfy your RMD and are not going to be taxed as income to you. So in planning for your required minimum distributions every year, and many of you have to take them from IRA or other qualified plans, think about whether you ought to use some of those dollars to do your charitable giving, which you may have been doing over the years, writing checks. If you do that, that amount comes out of the IRA, tax-free. And you contribute to charity and you're acknowledged as a giver for that amount. It's just a good strategy to use. If you can see on the bottom, if you have qualified plans other than the IRA, or in addition to an IRA, like a 401k, you can use those RMDs as long as you roll those amounts first to an IRA. So, for example, if you've got to take an RMD from a 401k, before you do that, just roll the dollar amounts of that RMD into an IRA, which is a tax-free rollover, and then take the RMDs out of the IRA and maybe take them out from the IRA as qualified charitable distributions and pay no tax. That's kind of number 3. Now, number 4, and really isn't known as number 4, it's part of number 3, is what is called Legacy IRA. Some of you may have already done this. The Legacy IRA Act began this past January 2023, not 2024, and it created the Legacy IRA Act. The Legacy IRA Act was created at the urging of charities, at the urging of advisors, philanthropists, saying, well, if we can take QCDs out to make charitable gifts tax-free from our RMDs, why can't we use those dollars to buy a gift annuity? After all, the gift annuity is a gift to charity, so why not? And the point is that you couldn't specifically do that under the prior rules that created QCD. You just couldn't do it. So we lobbied, we asked, we thought, we proposed to legislatures, we proposed to the Congress, and finally, in 2022, effective 1/1/23, we have a new rule. It says in bullet point 3, if someone's at least 70 and a half, they can distribute up to a lifetime maximum of $53,000 in 2024 from an IRA. It'll be a QCD and establish a gift annuity or charitable remainder trust. One or more of them. Maybe you do 5 of them for $10,000 each in 5 different charities, or maybe you just do one for $10,000 to a particular charity like Yad Sarah. Any of those dollars that come out of the IRA that are intended to be used to create a gift annuity will also qualify as tax-free withdrawals as QCDs. Here are some of the rules, though. You can only do this one time in one calendar year, which means if you do any of it in 2024, even if you don't do the whole 53, you can't do the balance of it in 2025. You're limited to one calendar year. So if you do $10,000 in 2024, you didn't use the other 43, didn't have to, obviously, you can't carry over the 43 to 2025. People in 2023 did this, but many of them said, well, I'm not real sure. I'm going to watch it and see what comes of it. It was very successful for those who did it. Now, when they get to 2024, because of the inflation index, 2023 was $50,000 maximum. If you do it in 24, it's $53,000 maximum. So ponder this. If you're thinking about gift annuities, and some of you already have done gift annuities, you're thinking about gift annuities, and you think about maybe funding a gift annuity from some of your IRA money, you can now do it. And you can do it up to this amount in this particular calendar year and use the funds coming out of the RMD tax-free. It's an aggregate amount, which means if you do them 1, 2, 3, 4, 5, whatever number of it is, you can do them up to a total amount of $53,000. And if you don't do it in 2024, you can wait to see what happens for 2025. So we may get adjustments in 25, but again, you've got to decide upon whether it's of interest to you. If so, what year is of best advantage of you? You've got to be eligible for RMDs, and if you are, you can use this strategy. This is the Legacy IRA Act. I'll point out to you, if you decide to do a Legacy IRA gift annuity with QCD withdrawals, and you also want to make outright gifts to charity with your QCD withdrawals, remember those amounts could be $105, and $53,000 are the amounts you can use for a gift annuity. Yeah, the number together can't exceed $105,000. Sounds complicated? We can talk about this independently. Advice you get from Yad Sarah is complimentary and it's confidential, but I want you, if you haven't already, be thinking about a Legacy IRA. It's a really useful piece of financial, tax, and estate planning. Another way to reduce an estate is for those of you who are philanthropic, who say, look, I'm at the end of the year, my accountant says I really need some substantial deductions. I haven't been thinking it through as much as I should have, but now that it's November, I better think of something, but I don't really know what charities I want to give and in what amount I want to give to them. So can I do something that enables me to get my deduction in 24, but not make any decisions about my giving until sometime in the future using those dollars? And that's called a DAF. A DAF is a donor advised fund. And DAFs are handled by Jewish federations, handled by the Fidelities and the Schwabs and the Vanguards in the commercial field, handled by private DAF organizations like in New York FJC, New York Community Trust, or New York's Jewish Communal Fund. There's a bunch of organizations that are created to receive your DAF contributions, to create an account for you in your name, and to let you recommend grants from that account from time to time so that you create it in 24, but maybe you don't make your decisions about any grants till 25 or 26. So think about a DAF as a way of banking some of your charitable giving for use in the future. And most often, DAPs are funded by appreciated assets, principally stocks or mutual fund shares, because you don't pay tax on the capital gain and get a full deduction. That's using a donor advised fund. Rachel, let me lean to you for a second and see if there's any questions.
We don't have any questions at the moment, but if anyone has any questions, feel free to put them in the chat or in the Q&A box.
Okay, thanks. I'm going to go to number 5, Roman number 5, a charitable remainder trust. This is a unique, important vehicle to consider, and it isn't as complicated as this screen makes it out to be. I'm going to just brief it for you. CRT, Charitable Remainder Trust, is a trust that's set up independently, simple trust, not complicated. You can oftentimes be your own trustee, or you can have the charity be the trustee, or a trust company, or a professional advisor. You create a CRT to run for life or lives. A rate is fixed based upon IRS rules. You contribute most often appreciated assets. Could be a piece of real estate, a work of art, could be stocks of a certain value, and those assets go in with no tax initially on the capital gain. You get full value. The rate is fixed. It's multiplied against the value of the contribution, and you get paid that amount if it's a charitable remainder annuity trust for the rest of life or lives. You want a trust that participates in market performance, you create a charitable remainder uni trust. Same rules apply, life or lives. The rate is fixed, oftentimes higher than the rate for the annuity trust, and every year the trust adjusts its value based upon market conditions, and it's multiplied by the rate you fix to determine next year's payments. Very valuable for people who have highly appreciated assets, who don't want a gift annuity. They want something that gives them more flexibility, and they maybe want to be their own trustee and determine the investments of the trust. And that trust is your personal trust. At the end of the term of the trust, when all the annuitants have passed away, whatever remains, it's called the remainder, goes to charities that you name in the trust agreement. That's a simple explanation of a charitable remainder annuity trust and a charitable remainder uni trust. But look at this chart for a second, where it shows rates are fixed. In the one to the left, it's called a CRAT, charitable remainder annuity trust. Individual makes a gift of property. Property could be stocks, which is considered property, works of art, real estate, makes a gift of property, gets a tax deduction for a portion of it because a portion is being used to pay an annuity, gets a rate of income, fixed income, with no offset for inflation, so you're going to get the same payment every year for life or lives. If the principal grows, or even if it doesn't grow in the trust, whatever remains end of lifetime goes to charity. This is the CRAT, where once the rate is set, or once the payments are set, you're always going to get them, as long as you're alive, or 2 lives, or whatever it's set for. That doesn't change. In a CRUT, charitable remainder uni trust, same gift of property, same idea of getting a tax deduction. The fixed rate is still there, but it's variable income, which means every year the trust at the beginning of the following year is revalued, or the end of the year itself. We know what it's worth at that point, and then we multiply it by that fixed rate for next year's payments. So this will grow with inflation, and oftentimes will grow at the market, so that if you're willing to take some risk tolerance, you'll get generally larger payments annually from a unit trust than you do from an annuity trust. People get wary of trust. Trust seems so complicated, but fortunately the IRS gives us the documents to use for these trusts. They're easy to understand, they're easy to explain. Charitable remainder trusts usually get higher funding than charitable gift annuities, although charitable gift annuities can take substantial funding as well. And they are separate trusts which have separate investment strategies and separate filings with the IRS. So a CRT, charitable remainder trust, is something for you and your advisors to consider. And we, again, can be helpful to you and your advisors in seeing whether a charitable remainder trust makes sense in your personal financial planning. How else can you reduce an estate? IRA planning. Okay, IRA planning. You know that the most expensive asset to die owning if you're vulnerable to estate taxes, is your qualified plan money, whether it be IRA, 401k, 403b, pension, profit sharing plan. It's fully includable in your state as a cash asset and may be subject to estate taxes. There are ways to deal with that. Under the current rules, there's a 10-year term your heirs have to receive and report those funds from the IRA. The IRS limited the term so that the IRA would be taxed fast, because remember, your IRA money was never taxed. You used pre-tax dollars to fund it. It grew and has grown, hopefully tax deferred. At some point when you reach a certain age, the IRS starts beginning to receive its taxes on what they call annual distributions, RMDs. So maybe you want to leave it to your heirs or to others. The thing is, though, you've got to plan for the fact that your heirs are going to have to receive the amount of the IRA that they receive within 10 years and pay income tax on those amounts. So what other strategies might there be? Maybe using the IRA for a charitable remainder trust. And instead of having it 10 years, maybe the term is for the children's 20 years or for their lives. And you fix a rate and they get paid every year at the end of the term of their lives. We will then have IRA proceeds and the remainder for charities, but you're avoiding the tax on the front and you're protecting them under the 10-year stretch rule. Complicated? Sure. Can it be done? And is it being done? Absolutely. And again, something to think about when you begin to speak this fall with your professional advisors. I hope that most of you realize that April 15 can be a difficult date. That's when you file your tax returns, and that's when you look at your tax obligations and say, oh my, what could I have done to make them less? And you start thinking about it. You think through the summer. You get to the fall, you think through the fall. There's holidays, there's Rosh Hashanah, there's all kinds of things happening. Before you know it, you're in October, close to November, and you still maybe haven't thought about, how can I reduce my taxes for 24? I didn't do much in 23. That's when you start talking to your financial and tax planners, your estate planners, your CPAs, and you say, what can I do now to avoid income taxes and to protect against the fact that maybe I don't live through 2025? One never knows. So these are things I'm suggesting that you bring up, not to do them reflexively and automatically, but talk to your advisors about. There are also people who have these kind of dilemmas, and I raise them just for informational purposes. If a family has a disabled adult child and is concerned about the support for that child after the lifetime of the parents, there can be a charitable remainder unit trust created with annual payment adjustments to benefit the child during the years the child survives parents. Or you can do it with adult children and create an IRA TRT that goes to child one and then to child two. There's all kinds of ways to do this. I raise this because although it isn't relevant to many people, it may be relevant to some and something for you to talk about. What do you do with other considerations? Well, if you've got assets that you expect to appreciate in the near term, you bought some real estate cheaply, maybe some land, and maybe you've gone through these quiet years when properties were affected by the pandemic and asset values were affected down and maybe there wasn't much of a market. But when the market picks up, when interest rates drop, and they may not drop in 24, but it's likely they'll start dropping in 25 and mortgage rates become lower and people get back in the market with a vigor. If you've got assets you expect to appreciate in the near term and you're going to find interest in marketing them and selling them, maybe you might want to use some of those assets and give partial interest in those assets to your heirs, some way to gift assets during lifetime to get rid of the appreciation and also get them out of your estate. And number two, sometimes there are assets subject to valuation discounts. Maybe you own a company, maybe you own some stores, maybe you own an operating business of any sort. All these things are subject to valuations, and the IRS makes those valuations or double checks what your valuations are. We don't want to get in a situation where there's considerations that put us into tax vulnerability when we don't need to be there. Now, Some final thoughts on this portion of the presentation. It's unclear what the tax exemption will be, the lifetime credit exemption will be in 2026. One thing we can be sure of, it won't be as high as it currently is by substantial means. When you are in your exemption year, which is now 2024, and you are at a wealth where you might want to take advantage of the unified credit that exists now while it's still at its highest, you should do it in 24. You wait till 25, and thereafter you're going to go back to not immodest amounts that are unified credits, but much lower than the amounts presently involved. So these are things to think about from an estate and gift planning point of view. In some instances, from a financial planning point of view, using a charitable remainder trust, for example, as a financial planning vehicle, gives you income for life, gives you a tax deduction, gets rid of capital gain, and takes care of family. Using a legacy IRA gift annuity, get some money out of your IRAs that are RMD money, tax-free, which is good in your financial and tax planning. And there are some of you in this seminar, in this webinar, who have over the years created charitable gift annuities for getting legacy IRA, who have seen the value of them. Rates are where they are, and they are higher now than they have been, but that won't be permanent. And I would suggest to you, those of you who've used just pure charitable gift annuities, one life or two lives, and may be considering doing more, or those of you who have not done a pure charitable gift annuity, but now are thinking about it, do the following, risk-free. Number one, get a new calculation. You're older. Remember, if you're within 6 months of your next birthday, you are your next birthday for rate purposes, and the higher rate comes from the older age. So take advantage of free calculations. Ask friends of Yad Sarah to send you something in confidence. Number two, consider the fact that the rates for Yad Sarah are at a place now where at the end of this year, it's very possible they'll have to be adjusted. I'm not sure if they'll be adjusted down very much, but they might have to be. So ponder the idea of taking advantage, those of you who are strong supporters of Friends of Yad Sarah, of doing your gift annuity, first one or your newest one in 2024, and get the calculation, determine how much of the income will be tax-free to you, how much your deduction will be if you itemize, what your fixed rate would be. Because in your financial planning, it's always good to know that some of your payments that you're going to get in your retirement years are going to be there. They're not going to be vulnerable to market conditions. They won't be bond payments where you can't be sure of the interest rates, or money market payments, or CD payments. There'll be gift annuity payments covered by and protected for you by New York State rules that protect annuitants, see that the resources are there for payments by the charity. So think about that in the context of what you may need in your financial planning for this year. Ponder your assets. Think about what you want to have to make your retirement comfortable. You want to be able to live the life you want to live. We're vulnerable sometimes to prices. We're vulnerable to any number of things, but they do just back and forth. But you want to try to do a lifestyle that you're used to, and to take into account taxes now and in the future, but take into account, importantly, income now that you can depend upon. Those are the thoughts I want to leave with you. Let me just go to the very end of this presentation. I want to remind you, all of you, one of the most important things to ponder as you plan your estate is your will, or your trust, or your retirement plan. In the case of bequests, when you write your will, when you review your will, if you're thinking about charitable giving, be specific in your will. Mention your charities by their true names. Some people use older names of charities. Get the correct address to your lawyer. Make certain the amount you want to give or the percentage of your estate you want to give is stated correctly. And make your will something that's a living document, something that every year you'll go back and review. It's very important. And if you're going to make testamentary bequests, think of your heirs, think of your charities, think about what you want to leave behind, think about how you want to be remembered, simply in your will or in your living trust. And of course, as I may have mentioned before, it may be even better for you from a tax planning point of view that instead of, or in addition to giving through your will, make some designations in your IRAs or retirement plans for charity. Any amount you designate at the end of your lifetime from your IRA to charity or charities avoids what we call the double tax. Double tax on IRA is there's the income tax at the end of your lifetime, and if you pay it now or you pay it through your heirs, it's still going to be due. And there may be an estate tax. So when you're thinking about doing charitable designations, talk to your advisors and ask them, should I do this through my will? Should I do it through my trust? Should I do it through my IRA or my 401k? Or should I do it through a combination to take advantage of the best tax strategy to have the best available money for my heirs and for my charity? You can also use a life insurance policy for your charitable giving in addition to or in replacement of a bequest. And that is oftentimes a good idea. You have a paid up life insurance policy, which you got years ago and may not need. If you gift it to charity now, they can't get the funds till after your lifetime, but you get a tax deduction for doing it, and that becomes your bequest. For some people, that is a bequest they can see happening during their lifetime, a gift of a life insurance policy, or maybe make a charity a beneficiary of a portion of a life insurance policy that you continue to own till the end of your lifetime. And lastly, look at this page. The rates for Yad Sarah gift annuities for May 2024 in sequences of 5 years. Beginning at age 7, you can see the rate is 6.5%. At age 75, 7.1. Between 70 and 75, it's some fraction in this midst. At age 80, sorry for the misspell, at age 80, the rate will be 80%, 8%, and at age 85, 9.5%, 90 plus 11.3. These are the current rates. They're high, they're generous, and they're appropriate for some of you who want to get these rates while they're still available. And you can see if you made your gift annuity in May this coming year, well, we're now in May. In May, these are the tax-free portions of your annual annuity amounts, depending upon what age you choose. So if you're 85 years old and you create a gift annuity at 9.5% is your rate, you fund it with cash, over 3/4 of your annuity payment is there for you tax-free annually. Very compelling reasons to do that. What are the reasons? A, high rate. B, tax-free income. C, a charitable deduction if you're itemized. And D, which I think is as important as A, B, and C, whatever is in that gift annuity is going to be available for your charity to use after your lifetime to carry out exempt purposes for Israel and for Yad Sarah in Israel. These are really, really important things you do. So I leave you with this conversation and remind you that you should feel free to check back in. You're going to receive a note and some information about the slides here to see if you want to have them to review with your advisors. You can call us whenever you want for questions or comments, and I'm just so glad that you attended today. Rachel, I'm going to turn it over to you for some closing comments and anything else you want to suggest.
Thank you all for joining, and as Neal mentioned, feel free to reach out with any questions, and if you want a copy of this presentation, also feel free to reach out. We're happy to send that over. Thank you
Okay,
all.
everybody, thanks very much. Thank you very much. We'll see you. Bye.